A company worth $47 billion couldn't explain how it made money, and Wall Street noticed too late. In 2019, WeWork was everywhere. Sleek offices, young founders, a mission to elevate the world's consciousness. Investors poured in billions, but when the company filed to go public that September, something broke. The prospectus revealed what insiders already knew: WeWork was burning cash at an alarming rate. They'd lose nearly $2 billion that year alone. So what happened? Why did the market suddenly care about the math it had ignored for years? WeWork's model was simple on the surface: rent large buildings cheap, subdivide them, lease small spaces to startups at premium prices. The spread, the difference between what they paid and what tenants paid, should have been profit, except WeWork didn't stop there. They spent lavishly on design, community events, free beer, and global expansion. Every dollar of revenue came with $2 of spending. The company was a growth machine running on investor fuel, not business fundamentals. For years, this worked. Venture capital celebrated unicorns, billion-dollar startups that didn't need to be profitable yet. The story was growth at any cost. Investors believed scale would eventually bring margins, but IPO documents forced transparency. The filing exposed that WeWork's losses were structural, not temporary. Worse, the founder, Adam Neumann, had borrowed hundreds of millions against the company while it was private. Red flags everywhere. So why didn't anyone see this coming? They did, but there's a gap between knowing and acting. Early-stage investors, venture firms, had already cashed out or held stakes worth billions on paper. They wanted the IPO to happen. Bankers wanted the fees. Momentum is a drug. It wasn't until public markets, with their quarterly scrutiny and institutional guardrails, stepped in that the spell broke. Within weeks, WeWork pulled its IPO. The valuation collapsed. Billions evaporated. WeWork's story isn't about fraud. It's about how incentives misaligned. Private investors, founders, and bankers all benefited from inflated valuations before the IPO. Public shareholders would have borne the losses. The company had a real product, people wanted those offices, but the business model couldn't support the price tag the hype had created. And that's why WeWork matters. It's a recent, vivid reminder that valuations aren't destiny. Eventually, cash flow speaks louder than narrative. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're curious about how financial bubbles form, from tulips to tech, subscribe. We break down the psychology and mechanics behind the manias that shaped markets. Subscribe, there's a new unsolved financial collapse every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.